Hey everybody, this is Jose Blasco. We are about to get started. Let's have a quick sound check as we always do. Quick hello on the chat box we do. I will know then that you hear me and we are ready to go. Please type a quick hello, my friends. I believe all should be good, but again, always good to reconfirm with you. Mark, how are you, my friend? Good to see you. I will turn on the video stream. By the way, I almost forgot. How are you guys? Good to see you, Joe. Good to see you as well. 10 seconds to go. Almost there. Here we go. Time to get started, everybody. Very good. So October 7, 2021, this is Options with Options. My name is Jose Blasco. As the name suggests, we are going to be looking at the markets and looking for options trades, options opportunities, managing our account, our portfolio, our trades. Before we start, please read the disclaimer carefully. This is important information. I am highlighting it on the upper left side of the screen. So please take a little bit of time just to read it. Do not skip it, as it is important. Clive, good to see you, my friend. Good. Sound is good. Fantastic. And again, the agenda for today, as always, we follow the same structure. So we're going to look at the market environment, talk about what's happening in the market today, review the trades that we have, talk about trade management. We'll keep that relatively short today, and from there we're going to move into trade executions. Okay, here we go. So the session is now officially introduced, and it's time to begin. How are you, Maka? Good to see you. Here we go. So here is our chart of the S&P, and by the way, if you compare, and I'm sure all of you are thinking about it, if you compare what we had yesterday as we were running the session and what we have today, I think that before we even start, the lesson to be learned here is that the market can move fast. Okay, and while the reputation of the markets is that they could move fast to the downside, but typically when moving up, they move more slowly. Well, this is a case where we can see the opposite can be just as true. Okay, this is 2 days with major movements in the S&P. Where we actually went all the way to a change of climate, even though the climate right now on the S&P is not confirmed. It's a blue dot, but it's not thick, it's thin. And in that sense, it is a non-confirmed climate. And therefore, we still need to be careful, take it easy, and so on. Okay. Now, yesterday, as you probably recall, the implied volatility of the calls and the puts were more or less at par, and that created a lot of uncertainty. Today we still see some uncertainty in the sense that the climate is not confirmed. Okay, so the day after we may have a sharp turn in the opposite direction. So again, we don't know for, I was going to say for sure, there is nothing for sure in trading, but you get my point. We don't know for sure this climate is going to be sustainable or not because it's not confirmed, right? So in this sense, we still need to be in that cautious mode, and therefore when I'm getting to plan trades later on, I will be interested in planning the same type of trades I mentioned yesterday, which is going to be long trades, short trades, as well as non-directional, if implied volatility allows it. Okay, because again, I would not be surprised the market crashes very hard in the following days. I would not be surprised that we are back to normal blue climate for 6 candles or more going up, like it normally happens. Okay, even though in the recent times it's not been the case. So still a little bit of caution, even though it is quite spectacular to see the 2 moves that we had yesterday and today. And this is going to very likely lead into let's call it a healthier market, moving to the upside. Also, by the way, following an Elliott wave turning point, the orange color is the long term. Okay, so if you look at the settings, edit study, if I look at the edit study of Elliott wave, notice how my settings, which are the default settings, imply that orange color is the long term. Okay, the long term. So based on Elliott wave, this is a long-term turning point, and this could bring the market up to 456, something like that, the orange region on the top. Okay, so again, those are very interesting analyses that are done for us by the Elliott wave tool, which is great, but at the same time, without the climate and the UFOs. So this is just an estimation, which could be fulfilled or not. And while it makes a lot of sense, it is always good to add more ingredients to this analysis. So my point is, with the Elliott wave turning point, and now potentially changing to a climate which is blue, which potentially in the following days is going to be blue and thick, meaning confirm. So now we may have an opportunity to reach to that orange target on the top, indeed. Okay. So things are looking to go back to the normal standards in the marketplace that we have most of the time in the S&P, which is basically going up most of the time. But again, the climate is not confirmed at the moment, so we cannot be overexcited, and therefore I am happy yesterday I had the time to enter a short trade that obviously today is working against us given the fact that the market is moving up, but I'm happy I have this trade in my account because if the market was to fall, that short trade is going to help. Okay, so we'll talk about this later when we review the trade. So a bit more on the analysis, talking about multiple ingredients. A new UFO form that was not there yesterday when we were running the session. The one below was there, but this one is new, and that one indeed is indeed helping or adding more odds for the market to continue moving higher, because if the market was to fall hard, it's likely going to bounce hard in the opposite direction. So again, on-field orders added in the marketplace certainly say or tell us a lot about the market environment and the market conditions. Okay, so in this sense, this is added information which is relevant. How are you, Ahmed? Good to see you. Very nice, everybody. So yeah, so from a volume in the options arena, we can see 1.9 more calls than puts. Okay, but to be honest, yesterday the trading of the calls was so much more significant. We are indeed above average, but yesterday the trading of the call was way more significant than today. So I'm not that impressed by this number, and I'm still, in that slightly skeptical mode, given the fact that the climate is not confirmed. Okay, so we will reassess this all together next week when we meet again on Wednesday. But indeed, my suggestion for you guys will be that tomorrow you redo the same analysis I just done now, because you are very likely going to see a confirmed climate, and that would probably bring in more confidence or a greater need to load on more long positions in your portfolios if that was to be the case. Okay, so just watch it one more day, and from there we should be clear on what the market environment is. From a VIX point of view, I'm looking at the VIX. Implied volatility has dropped to 19%. With multiple red UFOs. So this is in line with my comments below. Just like we saw green UFOs on the S&P, now we see red UFOs on the VIX. So all of this is quite bullish. Okay, so if the climate changes on the S&P, so that's going to be a powerful thing to see. Now, of course, yesterday I also said I wished I had a bit more time because the market was trading around 21 volatility, something like that, and we could have done some iron condors. Today with 19 volatility, we can still do iron condors and trades of that sort where we sell premium, but of course we will get less premium today, given the fact that many people now are in more relaxed stage and they are less eager to pay for those options, and therefore the prices of options are going down across the board. So we may need to do a bit more analysis until we find the trades that meet our rules, but that, my friends, is nothing new. It's part of trading. Okay, Joe, more calls yesterday. Somebody knew something. Yeah, I guess it's always the case. There is always someone who knows more than us, isn't it? So the beauty really with the options volume map is that they cannot hide themselves. Okay, if we go back to yesterday, right? And when you go back to yesterday, look at that. Okay, so that strike was traded like 100,000 contracts on that strike, where the other strikes were 5,000, 6,000, 12,000. So as you said, someone knew something, right? So again, the beauty of the options volume map is that it's a tool that you can certainly use to be either more aggressive with your predictions of possible or potential trading points. My preferred way on how to use it, more than being very aggressive with potential turning points, is more to use it as a tool that tells me more about if the moves are likely going to continue or not. Okay, so again, in this case, it would not have helped me too much yesterday because we were in a down climate, and this is suggesting the move will continue to the upside. So of course, I will want to see a confirmation when looking at the climate and the volume map, which in this case yesterday would not be the case because yesterday the climate was red. So the volume map is telling you it's going to go up, the climate is red. So there is a contradiction, okay? But in days when the climate is confirmed and you get to see these huge volumes, okay, and also the ratio 8 to 1, right? So that certainly tells you the market is very likely going to continue. And what's powerful here, something I appreciate myself based on my trading style, is to go ahead and maybe replan on my targets. Okay, maybe you had a target that was closer, and now you see this huge push that is coming from behind the scenes. So you could expect the market to go further out and move further than what you thought at the beginning, and then maybe you want to replace your target to a further target to position yourself to collect a greater profit. So again, it's kind of like how I like to utilize the volume map. Okay. So anyway, so this is what we have when it comes to market analysis, when it comes to positions. So Intel, very quick. I don't have too much more to add to Intel. We will look at the chart, speed of the light, just in case you were not here yesterday. But basically, Intel is moving up 1.1% today. The good news about Intel is that a UFO just formed. That UFO was not there yesterday. So now we have a little bit more odds for Intel to continue moving higher. Bad news is that October 15 is the expiration date. So I'm not sure that we're going to make a fortune on this one. Okay, I don't think so. So far, the trade is profitable. But again, if we have a little bit of an extra push, so this trade can indeed pay a bit more. Okay, so that's a good thing. When it comes to ADM, okay, so let's take a look at ADM. This is our teaser trade, isn't it? Let me bring ADM because here we got something happen with ADM. So I want to point at it. So I'm just opening a risk graph. Let me float it. So with ADM, we are currently trading at we are trading at 63.21. Remember, breaking even on this trade, if I'm not mistaken, based on yesterday's calculations, that would happen around 64 something. So let's look at the simulation here. Yes, and as you can see, 64.43 or something like that. This is where we start breaking even on the trade. So right now this trade is showing a little bit of negative PNL. And if I was to look at TOS and I look at ADM, so here it shows minus 58. But of course, the reason why it shows minus 58 is because today actually we just closed the 55 put on ADM at 5 cents, which is an order that we placed yesterday, if you recall. Okay, so we got rid of this put. Okay, which means that the real trade that we have here now is not exactly like that. Okay, the trade that we have now is a trade where if this market falls, okay, ADM is gonna be back in business when it comes to helping us a lot when it comes to a hedge. Okay, so let's take a look. Let's take a look at how this looks like. Okay, so look, I'm gonna simulate that we bought to close the 55 put we have at 5 cents, which is exactly what we did, right? So the trade we had was we sold the 55 put at 35 cents. We just bought it back today at 5. So I'm just adding that additional row with that position. This emulates that the trade is gone. That trade is that unit is closed, I meant to say. And when I do that, okay, notice how the risk profile goes up and then it goes down, right? So when I do that and I click OK, so now the risk profile goes up and only up. Okay, why? Because I got rid of the 55 put. So now I only have the 60 put and the shares. Okay, so now my break-even point to the upside is still 64.5 or something like that. So I need the stock to continue moving higher to get back into profits or breaking even. Okay, so I need a bit more of that. I just or the other thing is, I just need the stock to really fall or fall hard. Okay, so with that in mind, can we do something to help this trade a bit extra? Okay, because what we did yesterday was to place an order to close the 55 put at 5 cents. We did. So now we are helping this trade extra in the sense that if the market was going to crash, okay, this trade is going to start paying faster. Okay, so as long as we are trading about 58 something, which was before the target, if you recall, the target was 57 something. So if we reach 58 something, now we are back in business again, right? But at the same time, that's quite far. correct? And it's quite far, and the expiration date is quite close, which is October 15. So it's going to be difficult to help this trade, okay? But the question is, can we do something to help the trade, okay? Well, to know the answer to that question, really, I need to find out what are the strikes available, okay? And there are more strikes available, okay? There are more strikes available that were not available before, okay? For example, when we started the trade, we did 55 and 60. But now, precisely because the expiration date is closer, we can actually go ahead and use other strikes, okay? So for example, against the 60 put I own, I could go ahead and sell the 59 put. So if I do that, okay, if I do that, take a look at what's going to happen. Well, actually, I need to do that midpoint, okay? So I'm not sure how much I'm going to get paid for the 59 put because expiration is, it's happening quick, okay? But let's take a look. Yeah, I'm only going to get paid 10 cents. So really, then it's not worth it to do it because actually it's then if the market falls, you're not going to get helped, okay? And the break-even point is still around 64.36 now, which is just a bit better for a few cents. So it's not helping. And the problem is not helping is that October 15 is too close. So I cannot help the trade more. I tried, but I don't have premium enough to help this trade, unfortunately, okay? So, so then the next question is, so what can I do? Okay, what can I do? Because right now, okay, so if you look at this trade, the worst case, okay, the worst case for this trade is this bottom peak, which is we're gonna lose 151. Okay, so that's the worst case. Worst case, we're gonna lose 151. Right? In the meantime, we got in stock shares at 60.3, and those stock shares are currently trading at 63.30. Okay, so let's do a little bit of math here, so you will see where I'm going with this. And this is another beauty of combining hard deltas with soft deltas, combining share with options, which is now you have another way to try to tweak your trade for a benefit, which it's not always guaranteed because it depends on the prices of the options and the strikes available and all of those things. Again, options is not, I was going to say it's not straightforward. Options are 100% straightforward, but it's not straightforward in the sense that every stock, every underlying asset class will have different choices available. Some will have strike price increments of $5 at a time, some of $1 at a time, some they will have weekly expressions, some they will have monthly expressions only. So again, in that sense, it's not straightforward. You just cannot have just like a rule and always do the same. You need to analyze multiple scenarios to see which one may help you or may not, okay? So what's the case now? Well, the case now is that, if I do nothing, this trade could lose for me 151, okay? So if I do nothing, I'm just gonna lose 151. Now, if I close this trade now, not this trade, if I close my 33 shares at 63.3, which is the current price of the stock, knowing that I bought that stock at 60.3, okay, that means, let's run easy math. So I actually made $3. And because it's 33 shares, so that means I would have made $99. So if I close the stock now, okay, if I close the stock now, I'm going to make $99, okay? And if I do that, now it means that another way to think about it is that the put I had, which I paid 172 for, that cost is diminished by 99 cents, okay? So I would be left with less risk in the trade. So I could, of course, I would now miss on if the stock rallies, then I'm not going to break even, okay? I'm just going to exit for a smaller loss. So definitely that's one possibility, but I want to add an additional tweak to this, and we're going to evaluate if this would be worth it or not, okay? Again, so if I close my shares now, I'm going to make $99 on those 33 shares, okay? So the original put cost me 172. That put was diminishing cost by 35 cents, okay? And I closed that at 5 cents today, which means I re-increased by 5 cents the cost. So you may want to think about the put I have in the account, the 60 put, cost me 142. Now, if I close my shares of stock now, Okay, I'm gonna close it for $99 of profit, which is equivalent to the put cost me 99 cents less, which is equivalent to 43 cents. Okay, so in other words, another way to simulate my trade is, let me do that. I'm gonna bring in another risk graph, which is, you may want to think about being long the 60 put at 43 cents. Okay, so this would be the trade I would have in my account. Okay, if I was to do what I just suggested here, which is close the 33 shares, given the fact that I already closed the 55 put at 5 cents, right? So close the 33 shares, collect $99 in profit. I closed already the 55 puts. That made me 35 minus 5, $30 of profit. So I am now left with a 60 put that expires in October 15, where the net cost of this put is now 43 cents, if I add all the math I just discussed. So what is that put going to do for me? Well, it's my hedge in case the market falls. And if the market falls, I could make all that money. Okay, I could make all that money. But if the market rallies or stays the same or falls just a bit, then of course I'm going to lose $43, which is the net cost of this trade. Okay, so what can I do with this? Okay, what can I do with this? Can I improve this in any way? Okay, can I improve this in any way? Well, let's analyze what would happen. First, if I was to add a bullish component to this, and you're going to be like, what, bullish? Yes, let me explain. So what if I was to sell a put against the put I have? Okay, a put which is higher, which in this case would be the 61 put. So if I was to sell the 61 and keep the 60 I have, which, net cost me 43 cents. So the 61 put would pay me 25. Okay. And again, because the expiration date is so close, that's a waste of time because I collect 25. Great. But because the one I own cost me 43 net, I'm still paying a net debit of 18. So basically, I'm locking into a loss of $18 if the stock remains above 61. And if the stock goes below 61, now I am increasing my risk to become 118. Okay. So in other words, you could add bullish component, create a buffer there, because 61 is much lower than 63.41, which is the current price of the stock. So you are not really bullish. You are more in the neutral side, even though selling a put is bullish. But in this case, it doesn't make sense because having the expiration date so close, it only pays you 25, so it's not worth it. Okay. So what else can I do? Well, another possibility is to convert this long put, the 60 put, to a butterfly. And how would that be done? Well, that would be done by selling 2 of the 61, okay, and buying 1 of the 62. Okay, now again, given the fact that the expiration date is very close, we may not get premium enough to justify this trade, but it's always worth it to analyze it, keep the 60 where you had it, sell 2 of the 61, buy the 62. I got this wrong. Buy the 62. Okay, and by doing that, you will see a triangle shape risk graph as I click OK. 1, 2, 3. Here we go. Where now, if you stay more or less, if the stock drops to about 61, so you could make up to $65. So again, it's a little bit of a hedge in the sense that if it falls, as long as it ends up close to 61, you're gonna make some money. But if it stays outside, then you're gonna lose $33. Now, notice how $33 is less than 43. So, this approach is making sense to me. Why is it making sense to me? Well, because while it's not super and magic, that stock has proven to just range and be sideways more than trending. So I doubt, with a very little time left to expiration, which is basically a week and 1 day until October 15, I doubt, and maybe I'm totally wrong because I cannot predict the future, but I doubt that the stock, next thing you know, is going to be like the most incredible trending stock to the downside. And by doing this tweak, so I am reducing my $43 of risk to 33. and I'm giving that trade an opportunity to maybe end up with, $50+ of profit, if I'm, slightly in the lucky side, if you wish. Okay, because the stock needs to fall, but not only fall, it needs to remain between, let's call it 60 and 62. If it goes too low or stays above 62, then forget about it. You're going to lose 33, which is better than losing 43. Okay, but again, it's not like it's too magic. Okay, so this is one possibility, but again, there are more strikes. Maca, would it make sense to roll it into another expiration date? No, it wouldn't. It would not, and the reason why is because we are just trying to help this trade to hurt the least as possible, and in a perfect world, create a profit. But this trade, we cannot forget the history of this trade, right? Because then we get emotionally attached, and we try to do things with trades that already exist. So this trade is a trade that didn't work according to plan. So I am in, damage control mode. I am not in, let's keep rolling it to really, really convert the trade into a winner. Sometimes we can do that. Okay, sometimes we manage to convert a losing trade or a trade that didn't meet our plan to end up profitable. This is the beauty and almost the magic of options. But that should not be your goal when you are in damage control mode, because then you are not being realistic. Converting a losing trade into a profitable trade is not going to happen that often. Okay, you need a little bit of luck as an ingredient for this to be the case. So when you move from normal mode to damage control mode, the main priority is to reduce the risk. That's the main priority. And then as a second priority, give the trade a second chance to potentially become profitable. Now, going into now, close the whole thing, roll it, to a different expiration date. That to me is a new trade. And then if it's a new trade, my question to you would be, okay, let's look at the chart. Are you bullish? Are you bearish? What's your entry point? Where's the target? So then everything starts from the beginning, right? And that's not the plan, in this case. Okay, remember, this was a hedging trade, and we are just basically working with it to try to mitigate the risk and give the trade a second chance. Okay, but there is no guarantee, because, if you are thinking I'm going to roll it, subconsciously you may be thinking there is always one way to get a losing trade to become profitable. And if that was to be the case, well, that would be the holy grail. Okay, and again, options are amazing, but there is no free money. Okay, so we always need to keep that bias under control. And I know where you're coming from, Maka. I know your question is a proper question coming from an educational point of view and so on. But I want to warn you all that it's very easy unconsciously to, next thing you know, develop a bias where you are loading options so much, the next thing you know, you always want to give trades a second, a third, a fourth, a fifth chance. And that doesn't make sense at some point, because if you think about what's happening with this trade, this is a stock that should have failed, and that stock is currently trading at 63.43. Okay, it went all the way in the opposite direction by a lot. Okay, so if we could, instead of losing $140, that was the initial risk of the trade, we could end up losing 33. That is damage control mode. And if every time you're going to be wrong on a trade, you manage to reduce the risk that way, at the end of the year, you're a champion, because then your profitable trades are going to make your account look amazing. So that's what we're doing. And I'm keeping this explanation long because it's relevant and it's very important. And I know you're coming from the right thinking, Maka, but again, there is just a little fine line there that you step on the other side, and now you are almost hoping, right? And we need to control those human emotions that often happen on the subconscious mind. Okay, with such a short time frame, why not a double diagonal calendar? Because a double diagonal or a double calendar really pays you well, Joe, with an increase of volatility, and precisely because time to expiration is so short and there is no earnings, anywhere, close. So the probability of this to happen is very low. So the only way your double calendar or double diagonal will work would be to bet on a very, very, very short range. And again, given how the stock is moving, the probability that the stock end up in a very, very short profitable area is also very low. So again, there is no, we are doing magic, but at the same time, there is how much magic we can make. Okay. Yeah, very good. Yeah, earnings are on November 4. I get you, but that would mean that now we need to roll all the expiration dates, all the strikes to November 4. And again, that's a new trade. Okay, so we could certainly explore an earnings play, but that would be a different trade. Okay, so we gotta keep the focus there on what this trade was for, why did it fail, and what can we do to help it. Okay, cool. So anyway, so let's continue what we're doing. Okay, so it seems that converting the trade into a put butterfly, okay, also known as a short butterfly in some cases, that would help to reduce the risk of the trade. Okay, bringing the risk down to $48 now, because you know the price has moved a little bit since I was talking about it. So $38, which is better than 43. But what if instead of 60, 61, 62, I do 60, 62, and 64? What if we do that? Okay, so let's take a look. If we do that, the risk now becomes 85, so it's not helping. Okay, and therefore we're just not going to do it, even though the reward is more now. The reward is 100 plus, but we are just not going to do it because, again, because we're in the match control mode, the whole plan for the trade is to reduce the risk. Okay, so we're going to do 60, 61, 62, and I'm going to place the order, and after I'm going to make a last comment. Okay, here we go, we have it. Okay, so we are moving from $43 of risk to 38, and in a moment I'm going to make a last comment so you will understand why we're doing this, and you will see how this could help us even better. But again, we need a little bit of luck here, okay, guys? And I hate to use this word, but let's face it, if a trade worked against you, so it's not like you're trading a plan. You are in the match control mode, and the moment you're in the match control mode, it's like you're a sportsman. You know, I love Formula One. You probably know that. I'm sure I've said it in other sessions. And let's say, your engine is giving you problems, and you had to come back to pit, and they had to do a reset on the electronics of your car, and you start last in the race. So you are in the match control mode. Now, could you win the race? Yes, but probably it takes luck. Apart from your skill, many other drivers need to crash their cars for you to win. Does that make sense? That depends on other factors that we have no control about it. So that's what we're doing with the trade. We're in the match control mode, right? So but anyway, so let's do this conversion, and then I'll make this additional comment, and you'll see. So going back to TOS, we're going to look at ADM. We are looking at October 15. I'm going to use, a vertical. It doesn't matter what. I just need 2 rows, so I can make it a custom, and now I can work on this. Okay. So first of all, I need puts. I should have clicked on the other side actually. So I need puts, and we said that I'm going to buy the 62, and we said we're going to sell 2 of the 61. Okay. Did I say this right? Interesting. So 35 minus 20, that to me is 15 cents. But based on TOS, it's minus 7. So what am I doing wrong here? October 15, sell 2 of the 61 and buy 1 of the 62. So this credit here is quite disappointing based on TOS. Let me go ahead and do one extra confirmation, just so I make no mistakes. So I'm just going to get into another risk graph. I just want to enter, because top is giving me real-time values, right? So I'm just going to use October 15, sell 2 of the 61 put and buy the 62 put. So how much premium is this supposed to bring in? 3 cents. Buy the 62, sell 2 of the 61. Is that what I got? Buy the 62, sell 2 of the 61. 20 and 38. Oh, of course, because it's 2 units. Oh my God, I'm not sure how I was doing the math in my mind. Yeah, so I guess that we're gonna, yes, sorry guys. I was doing the math in my mind, like, 38 minus 20 should be 18. Yes, but that's so silly of me. We have 2 units, okay? So it's 20 and 20, okay? 20 and 20, that's 40 minus 38. So that's 2 cents point something, which is rounded to 3 cents. So that is not making sense, guys. That is not making sense for me to do the trade. I guess that a bit earlier, when I was doing the simulation, there were a bit narrower spreads. Okay, so we are still going to place the order in the system, but I'm going to be more demanding than that. Okay, I'm going to be more demanding than that. So if you think about what we said about the risk, we said the risk was dropped from 43 to 33 when we saw it earlier, so that's 10 cents. So then what I'm going to do is, and I may not get filled, okay, and if I don't get filled, it's okay, I won't get filled, but I want to get at least 10 cents. If I don't get 10 cents, I'm not interested. Okay, so I'm just going to place this order in the system. And by the way, remember that as I place this order, I need to go ahead and close the shares. Okay, I need to go ahead and close the shares. So I'm going to confirm and send to sell 2 of the 61 puts and buy 1 of the 62 at 10 cents. I won't get filled immediately, but hopefully during the day I will. Okay, so the order is here, waiting to get filled at 10 cents. And then what I'm going to do is I'm going to right click, okay, to create a closing order to sell 33 shares of ADM. Let's do it market. And I'm going to close the shares. Okay, that's it. I just closed the shares. So in other words, right now in this account, for this trade, I am left only with a 60 put. And while I am left with a 60 put only, I am waiting to sell 2 of the 61 and buy the 62 to convert that into a put butterfly. Okay, so I'm waiting for this. Okay, so let me document this on the portfolio page on top. And then I want to make this additional note in case you guys get filled during the day with those additional 10 cents, so you know what to do. Okay, so let's go ahead and do that. So position window. Okay, and it was silly of me to close that earlier, but it's okay. So I'm just reopening the risk window with my stock here. So let's edit. Okay, so first of all, we said the 60 put had an equivalent cost of 43 cents, which, to be honest, I would need to recalculate to know exactly, because I just got filled at a very specific price on the stock. So let's do quick math. Okay, so we sold the stock at 63.36. Okay, 63.36, and that stock was bought at 60.3. So we made 3.03 times 33 shares. That is 100.98. So this divided by 100, that is 1.0098. Okay, this is the equivalent cost that the put was reduced by. So if we go back to top, the original cost of the put was 172. If you remember, we sold a put against it, got paid 35. We just closed that put at 5 cents today. So the net cost of the put was 142. And now we just calculated by closing the stock at the price we just did. We basically discounted the cost of that put to become 0.41.002. Okay, so this is the price. This is the equivalent price that we're going to use in here. Okay, so this is the price for my put. So now what am I trying to do? So what I'm trying to do is sell 2 of the 61 at whatever price is available and buy 1 of the 62 at whatever price is available, which ideally will be 10 cents. And if I get filled, this is what I get, okay, which is the same graph I got before. So I'm gonna keep this, I'm gonna float it and leave it outside the platform. But I'm just gonna keep this window with me. So later, if during the session we hear the field order, so then I will customize the prices and copy and paste. I will right click and copy the position to the clipboard so I can paste it in my position panel. So then we can talk about it in the future sessions, okay? But here's the trick, okay? So here's the trick. So let's say I get filled. So what is gonna be my position like? My position will be made of buying the 62 call, selling 2 of the 61, call, sorry, not call, this is put, selling 2 of the 61 put, and I own the 60 put, which is the one which is the original put from this trade. Okay, so here's the trick. The stock is currently trading at 63.32. In other words, the stock is somewhere up here. Okay, so 62 is down here, 63.32 is up here. Okay, so the stock is above, right? Now, what if, okay, what if the stock keeps going higher? Well, if the stock keeps going higher, those puts that you're short will lose value. So what can you do? You can go ahead and close them at 5 cents. Okay, you can close them at 5 cents. So you collected 20 and 20, you buy them at 5 and 5. Okay, so that's gonna pay you, that's gonna basically lock in $30 of profit. But it's not about the fact that you're gonna lock in $30 of profit. If you remove the 261 puts, if the stock keeps going higher, because if the stock keeps going lower, you welcome it, right? You know, as long as the stock keeps going lower and approaches 61, now you're gonna end up in the green area, so you welcome it. But if the stock keeps going higher, then you are locking in your loss of how much would that be? $38.52. Okay, so but what's the good news? The good news is that the 61 puts will lose value, so you will be able to close them at 5 cents. So let me simulate that so you see what happens next. So let's pretend that I sold this at 0.05 and this cost me nothing, right? So if you think about it, 0.05 times 2, okay, and nothing, so that is a credit of 10 cents, which is what I am asking to get with my order if I get filled, right? So this is exactly what I'm gonna get, okay, if I'm right on the trade, and this is gonna bring my risk down to 31. Okay, now let's say the market, okay, let's say the market goes higher. Okay, let's say the market goes higher, and now you can go ahead and you can buy back those 261 puts at 5 cents. So what are you left with? Well, you are now left with 2 puts where your risk is back to 41, which is less than 33. Why? Because you left 5 cents on the table times 2. So you are back to the risk you are now. But what's the beauty? Now you got double the deltas on the way down because you got 2 puts. You are long the 62 and you are long the 60. So if the stock falls, and even if the stock falls not that much, let's say to 61.5, so next thing you know, now you are showing performances of 121. Why? Because it's not only 1 put paying you, now you got 2 puts. So in other words, basically converting this trade from a long 60 put to a put butterfly is for me to give this trade a second chance to either reduce the risk or now end up with 2 puts at the same cost instead of 1 put at the same cost. So if the market was to fall, this trade would now serve as a hedge and start paying faster and sooner with a break-even point, which instead of being below 60, now the break-even point it's 61 point something. So I am improving my break-even point, to be precise, 61.59, as you can see here on the right. So you are improving your break-even point and you are improving the amount of deltas in case the market was to fall by doing this little trick, if you wish. Okay. Now, of course, I depend on what the market is going to do. I need those 61 puts to become 5 cents. They are currently trading at the midpoint between 15 and 25 is 20. So they need to decay by 15 cents, which would happen very quickly if the stock moves a bit higher as time passes, as we got a weekend around the corner. So, you may very, very likely get those puts out of the way. And then if the stock falls, let's say into Monday, Tuesday, next week, whatever, next thing you know, now you may find yourself with, $50, $100, $150 of profitability on a trade that basically you would have been happy breaking even. Okay, so you are giving the trade a third chance while you are still in damage control mode. Okay, so this is what we're gonna do with this trade, and I'm giving you a lot of detail because this may happen while I'm not with you guys, because I won't meet you again until next Wednesday. So I want to make sure all of you understand. But again, all of this depends on us getting filled today at 10 cents. Okay, so far, this is what we have. Okay, we are waiting to get filled on the 261 puts and the 62 put, waiting to get filled at 10 cents. The current mark is 5 cents. So we will need the market to fall by a bit to give those puts just a bit more spice so we can sell them at 10 cents and get that fill. If not, this is a day order. This will expire at the end of the day, and that's it. You end up with the long 60 put where the most you can lose is $43, and if it falls much, $41, and if it falls much more, then you're gonna still be able to profit some as long as the stock goes below 60. Anyway, very, very long explanation, but my friends, that's how it is. And that is how you take a trade that did the complete opposite of what we expected it to do. And next thing you know, you may end up, still using it in a profitable way in both directions. Guys, please let me know how you feel, because for whatever reason, it happened to me twice in a row, yesterday and today. I didn't think I was going to spend that much time, but it was needed. So anyway, I was planning to talk about ADM, but I'm not sure how. I was not expecting to spend so much time. Well, I needed to explain what I did. Anyway, so CL currently still showing a little bit of red. Pfizer showing still red. KBH showing red. Why? Because KBH is the short trade we entered yesterday. The market went up. Okay, and Twitter is the one trade that is now providing some profitability coming in. So let's take a look at those charts very quickly. So if we look at Colgate-Palmolive, again, we are moving higher, but of course we need to continue moving higher, and then it's going to be back in business. Okay, so let's see. When we look at Pfizer, same story. It's coming back up. Okay, 1.89%. That's a nice move. That says a lot, but again, it needs to go above the purple area to get to be into profit mode. So let the trade do its thing. When it comes to KBH, which is the one we entered yesterday, then the opposite is true. We entered KBH right here yesterday when the price was 38, 70, something like that. And it's currently trading $1 higher. It went 1.77% against us. So obviously, this hedging trade is working against us. So at the moment, it's all good because the S&P climate has not confirmed, so I cannot do anything about it. I just want to have it in the account. So if the market was to fall, this trade is going to help, because my other trade that is hedging, which is ADM, is basically dead, given the fact that October 15 is around the corner. Okay, so I don't want to touch this trade. It's working against me, but it's good. Why? Because it's a hedge, and that means that Colgate, Pfizer, Intel, all those other trades are working my way. So let the market do its thing, and ideally, I find another long now. Okay, cool. And then with Twitter, which is here, so we are very well placed in the purple area. The red line is indeed within the purple area as well. So really, there is nothing to be done with Twitter. Everything is looking just nice. And we are just going to go with the flow and just wait for more time decay to be accumulated. And thank you very much. Okay, so that's it. Okay, so with all of this said, we are done with all the review of trades, and it's now time to plan on a trade. And I would like to find a long, because again, we have a very, very likely situation, which is the climate is going to turn to be blue, and my long positions, are still suffering a bit in the sense that the market went against me by a lot. So they are coming back to life, but we may end up, in a fully controlled position or not. That time will tell. In the meantime, if the market is gonna not push much and only push a bit, so those long trades are not gonna profit enough. This hedge with KBH is not gonna profit either, because if the market is gonna be just kind of like ranging and not moving too much. So I would like to find a long trade that belong to a strong sector. So if the S&P was not to move too much, at least this trade to have potential to move a bit more aggressively to the upside. Okay. And by the way, I'm noticing that something is wrong with my background for whatever reason. I'm not sure why. It shows a little bit of my green screen behind me. So, okay, interesting. Sorry about that. But anyway, so let's look for a positive CIV spread situation, looking for a long opportunity. We are looking at cheap options, but I look at that later. Stocks, I want the stocks to be strong to the upside. Okay, so looking at strong stocks to the upside. I want to be a bit more demanding, given the fact that the market is not fully confirmed. So let's add a component on the intermediate trend strength for the sector to be in our favor. Let's see if we find opportunities. If not, I will uncheck it. This one is not critical, but it's a good one to have if you could afford it, if the market is giving us that choice. I'm going to load my penny increment options list. Nothing on strength and Elliott wave. Earnings, we're going to exclude the next 30 days. And then when it comes to the climate, so I would like the climate to be confirmed to the upside, and early on the weekly, I would like the climate to be confirmed to the upside and sensible on the daily. That would be beautiful and even more beautiful near the 9 EMA. That's a lot to ask. Yes, and we got a no. So let's start on checking to see where we find opportunities. So with the weekly and the daily confirm, it seems that we don't have any. Yeah, so the weekly is not giving us the chance. What if I uncheck the intermediate term strength? It's not helping either. So again, because the S&P dropped so much, we don't have any stock that belong to strong sectors that show weekly climates up. So I'm gonna have to go ahead and rely on the daily climate only. Okay, and go for it and see if that provides some list. Okay, and to my surprise, we don't have anything, so that is not so good. So let me go ahead and remove the midterm, and we end up with two only, which is Marvel and CRM. Okay, so this says a lot, to be honest, guys. Okay, when it comes to our analysis of the S&P earlier, and we saw that the climate is not confirmed, there's a reason for that. The stocks that belongs to the strong sectors are not pushing that hard yet. That's why the intermediate term strength, it's still not giving us any okay when I filter using that check mark. Okay, so in other words, I'm of course I need a trade, so I'm gonna go for it, but we don't have too much to choose from. Okay, that's why tomorrow probably is a much better day to start finding trades. So anyway, so what if I re-add my condition with the weekly? Are any of those working? No, still not. So with all cases, no matter what, we have two cases, and we're gonna have to go with it. Okay, now from a implied volatility point of view, let's look for cheap options. Any of those are cheap? No. What about cheap from a historic volatility point of view? Marvel. So let's take a look at Marvel, because it seems the options are cheaper compared to CRM. So let's take a look at Marvel. Mark, got you. You're talking to Chuck. Understood. So let's take a look at Marvel and see what we have. Wow. Yes, it is indeed very strong, but we're not going to be able to trade this, okay? Because it's moved way too far, way too far, 5% up. So this is way too late. I mean, Elliott wave turning point already went to the target, so way too late. So we cannot take advantage of that. It's already moved way too much. So then the other trade was CRM. Let's see if CRM is also a low volatility condition. So I'm going to use my technique number 3, which is top decrease in the CIV mean in the last 5 days. CRM is one of them. Okay, so if we look at the implied volatility of CRM, it's been dropping a lot. Okay, so it's not super cheap options, but it's indeed not expensive. So that's pretty okay. The setup, we can see here, the climate is confirmed, so that's good. So now, if we're gonna take this trade, okay, of course, with the 55-minute time frame, as you can see, we got 44% probability, so that's not good. Putting on the side that we are looking for a retracement to 273. So we need to be a bit patient there with that stock, okay? Because it's not reached, okay? It's not reached the EMA, but in any case, even if it reached the EMA, we got 49% probability. So this time frame is not giving me an okay, a go ahead. So I need to find more UFOs. So I'm going to move to the 89-minute time frame to see if the 89-minute time frame is providing me the UFOs I need, and data is being downloaded. So bear with me. Now, yes. Okay, so now I got 274 all the way to 267. So this is indeed within this area. I like it. Okay, this is within that area. This is nice. Probability is 54%. So now we got something. So now if we plan for a target, okay, and I look at that pivot high and I project it. Did I click this correctly? I don't think so. Let me zoom in. Yeah, I don't think I clicked on the right candle. Yeah, so let me click on the next candle, which is right here. Here we go. And now we can go ahead and see where the target is. Here we go. I didn't click on the right place, so that's why. So the target would be located at 294. Okay, this is where the target would be located. And I'm gonna go ahead and say we take the trade now. Okay, and the reason why, even though we have not retraced to where the UFO is, okay, which that would be a perfect entry point and then expected to go there. The reason why I want to say that is because we just got an Elliott wave indication. Well, actually, no, we cannot, because the Elliott wave indication is happening today. So then you will need to enter tomorrow. Okay, so let me tell you the rule so you know. So if the Elliott wave diamond was to be on the prior candle, and today you are above the high of the prior candle, you can get in. And my backup plan is the fact that there is a UFO. So then I'm confident that if it's not going to break up and follow, and it's going to break up, fake out a little bit, then it's going to come to the UFO and then continue. And I'm okay with absorbing those fluctuations. Okay, it's not so much of a big deal to go from 277 to 274. It's okay. So so I'd be okay to do that. But the thing is that I didn't look at this correctly. So this diamond, this Elliott wave diamond, suggesting this turning point, is actually happening in the current candle. So based on Elliott wave, you can only get in tomorrow if tomorrow price goes above today's high. Okay, so you will need to wait. Okay, in any case, this is indeed helping the trade. Okay, a lot. Because it may create a lot of follow through for all those Elliott wave traders around the world, and that would be nice. But in this case, we're gonna have to wait for a retracement, okay? And when it comes here, then take the trade and ride the move to the target. Okay, so I won't be able to plan the trade now because we are just a bit too far from the entry to do that. But just to kind of summarize how you would do it, so you can practice that yourself. So you would come to the strategy builder. Right, you would type your target, which the target is 294. Sorry, on CRM. So you would type 294. Okay, that will give you the time to target, which is November 5. That's what you need to know. November 5 is the time to target. So with that in mind, okay, we need to find out more about the earnings. So the earnings for that stock are happening on December 7, right? So you will want to use the December expiration, even though the target is supposed to be reached in November 5, you will want to use the December expiration for the trade, shooting for this target located here at 294, okay? So that would be the plan on this trade, and then you can use the spread select to plan the trade, which I won't do since it doesn't make sense to do it now, okay? In any case, we got a couple of minutes left, and I want to look at your questions on the chat box. And if there is anything else that you would like to ask, this is your time, my friends. If not, please share with me how is the session. How was the session today? It was a bit on the complex side, I would guess, but I'd like to get something more concrete from you when it comes to how the sessions are helping you or not. So I know how to adapt the sessions the most I can to your needs, guys. So please, this is a great time for you to share with me how is it going so far. And I will be reading your comments there, Chuck. So you think price will break through the three UFOs? Yes, yes. And the reason I think you mean those three red UFOs on the 89-minute time frame. Yes, and the reason why is because the climate is blue, and that stock belongs to a strong sector, right? And again, the S&P is now becoming blue as well. So all of these, in an up climate, sell on field orders tend to be cancelled and buy on field orders tend to be added. So with this in mind, those three UFOs are less relevant than what they look like. So could they provide some sort of a short-term move to the downside and maybe bring price back down to the green UFO at 274? Yes, indeed. But it doesn't mean you will not reach your target at 294 in that expected date of November 5. Okay, so yeah, I would not be intimidated by them if that was the question. Thank you for that, Ahmed. Mark, you are working on getting better at the use of the platform. Very good. Very good. So yeah, again, the platform has so many things that, if you plan to use it all, it's indeed complicated. Now, if you focus on just the key tools that you need, I would think the platform is quite simple to use, probably simpler than other platforms. But at the same time, I could understand and definitely I welcome you and suggest actually that you do that, which is to explore every single angle of what top has to offer, so you understand all the tools available, because there are certain tools that you may never had in other platforms that could really help your trading, and that would it would be good for you to know they exist, and you can only know that by exploring a little bit, right? Ahmed, thank you so much for your comment about simplifying options. Um, I think that in the end, it's like everything in life, right? Practice makes perfect, and hopefully my explanations, the lecture time, is helping you to understand, and this together with your hard work, which I know you guys are working hard on this, and congratulate you for that. So this is what is helping you to digest, and then something complex becomes second nature in the end. Okay, so hopefully I'm doing a good job, and thank you for that, Ahmed, with helping you to digest. But at the same time, you're in the end, you will master options because you are the one putting the time and the effort. So I indeed congratulate you on that, and please count on me on whatever you need from me, guys, and the whole team. So email me. Don't feel shy. Don't be shy. Email me with questions, or if you have feedback for the session and you don't feel like sharing now on the chat box, but you're like, Jose, you know what? Your sessions are too much of this or too little of that, or what about you do this? What about you do that? Make sure you understand. I'm very very happy to listen to you guys, and I'll do my best to accommodate whatever it is that you need. Okay. Cool, my friends. You take care. And again, sorry for the background. I noticed the background is getting worse by the moment. I don't know if maybe my lighting is, for whatever reason, went a bit lighter or something like that. Anyway, you guys take care. See you on Sunday on the top session, and see you as well on Wednesday next week when we are back in the regular trading sessions for options. Take care, my friends. A pleasure as always. This is a special time for me during the week when we get together. So thanks for making the time to join me. And if you watch this recorded, thanks to you as well. Take care, everybody. Bye bye.